Well, good morning, Tony Virtue speaking, Virtue and Partners with our regular monthly update, and just the last days of winter coming through, hopefully. So I think psychologically that will be good for all of us. Obviously, things still dominated by this virus, particularly in Melbourne at the moment. My article there just shows the history of the Spanish flu lasted a couple of years. There are actually 4 separate outbreaks behind that. Killed 50 million people, and about a third of the population at that time was affected. So I guess the message with this is we're just going to have to be pretty resilient and accept that there'll be some days will be better than others, but we do need to get back to business. We are now in the annual meetings or annual season of year-end results, should I say. And look, so far I think they've been pretty reasonable. Quite a tilt in the market, and you can see in my article there comparing Westpac with Afterpay. So the 4 banks have really struggled. You can see their dividends are down, or in Westpac's case, eliminated. In context, that is a function of them making reserves for delaying the mortgage payments of clients. About 1 loan in 10 has been deferred for 6 months at the moment. Now, on the basis that they don't actually foreclose, then that should come back into the profitability at a later stage there. But you can see the afterpays and the wider, what they call the waxes, and there's an index now that you can actually get over these, ATEX. So they've been going gangbusters, almost like reflecting what's happened in America with with what we call these FANGs. And Apple now worth $2 trillion, doubled in value through this epidemic over the last 6 months or so. Now, this is quite important because it's going to change the way we're investing. Traditionally, Australian equities have been a dividend play. Providing the dividends were there, the franking credits, that was often half the actual total income you would get from an investment. Whereas overseas, it was primarily a growth investment. So we're going to have to tilt a little bit towards this so that we're going to be looking at more growth type stock for the foreseeable future in Australia. Now, from an earnings point of view, that should be okay, but it will mean drawing down on some of these assets to meet income needs. In other words, they're not paying the same level of dividends as more mature businesses there. Finally, property at the moment seems to be holding up. Obviously, that's a function of employment, a function of people feeling safe in their work, a function of getting overseas students back into Australia. And as you know, I teach in Adelaide, and we now have students coming back from overseas there for the first time. So hopefully those quarantine rules can be extended both to students and to net migrants, which have really driven Australia over the years. We're coming to the year end as far as reporting goes. So those reports will be out to you shortly. And as you can see, more and more of the ongoing advice now is being done by Zoom, which is proven to be a real boom in this environment. I'm probably a bit zoomed out, but it's a great way of communicating, particularly if there's a number of people from different sites that need to be involved. We're in good shape here. We thank you for your ongoing referrals. Do look on the website. There's a lot more information there. This is also a very good time to look at fixing interest rates on your debt. Hayden's been doing a lot of work there in the mortgage side. So opportunities to have cash flow positive investments, whether that would be a residential property, whether that be higher yielding shares. So plenty of opportunity here if we can just pivot and look to the future rather than dwelling too much on the past. That's enough for today. Tony Virtue, when experience pays.